In this video, we will see about value-added system of tax. What is this system and why this system exists? So let us begin. First of all, why was this concept introduced? It is because of two major reasons. 1. To eliminate double taxation. And 2. To eliminate cascading effect. What are these double taxation and cascading effect? We will see step by step. Let us understand with few transactions. Transaction number 1. This is Gopal, a raw material supplier. And this is Raj, a manufacturer. Raj purchases raw materials from Gopal. So this becomes a sale transaction between Gopal and Raj for sale and purchase of raw materials. Let us say the sale price of raw materials is Rs 10,000. This begin and sale transaction. GST will be applicable on this. Let us say the GST rate in our example for the goods sold is 18% for the purpose of our example. Thus, the GST on this transaction will be 18% on 10,000, which comes to 1,800 here. In this situation, Raj will have to pay 10,000 rupees as sale price and 1,800 in the form of GST to Gopal for purchasing the raw materials. Now, Gopal receives a total of 11,800 rupees from Raj. And from this he keeps 10,000 to himself and pays 1,800 as tax in the form of GST on sale to the government.
Let us understand again how the GST reached the government. GST is charged on sale. In our transaction number 1, there was a sale transaction between Gopal and Raj, where Raj purchased raw materials from Gopal at a sale price of 10,000. Because this was a sale transaction, GST is applicable on this transaction. So Raj will have to pay 10,000 towards sale price and 1,800 as GST on this sale price to Gopal for the purchase of raw materials. After the transaction, Gopal, who received this total amount of 11,800, will have to pay the GST collected by him to the government. That is, Gopal will pay 1,800 rupees to the government. This way the government receives the GST. Now, if you notice, here Gopal is only an intermediate between the buyer and the government. This is because actually the GST is paid by Raj. And actually the GST is received by the government. Gopal, that is the seller, is only an intermediate between the two. This is how the GST works. Let us take a look at this table. From transaction number 1, the government has received GST of 1,800. Now is it 18% of the sale price? Yes, it is. So we are on the right track. So let us go ahead.
Now Raj, who is a manufacturer, transforms this raw materials purchased by him into finished goods. That means he does some value addition to the raw materials and then those raw materials gets converted to finished goods. Now, after converting raw material to finished goods, Raj sells this finished goods to Akshay, who is a wholesaler. He sells this goods at a price of 15,000. That means he purchased raw materials for 10,000, did some value addition to it and now is selling it for 15,000. This means this increase of 5,000 includes the cost of value addition done by Raj and the profit margin of Raj. Again, this being a sale transaction, GST will be applicable on this. So, Raj will have to sell it for 17,700, that is 15,000 plus 18% GST, which comes to 2,700. Again, same like transaction number 1, Akshay will pay 17,700 to Raj. Raj will keep the sale price, that is 15,000, with him and pay the remaining 2,700 GST collected by him to the government. Now, the government will have 2,700 as GST from the second transaction. Is it 18 on the sale price of that particular transaction? Yes, it is 18% on 15,000. So again we are in the right track.
Let us go ahead. Let us take transaction number 3. Here, Akshay, who is a wholesaler, sells this finished goods further to Ramesh, who is a retailer. He sells it for 19,500. Again, Akshay, who purchased the finished goods for 15,000, is selling it for rupees 19,500. We can say the 4,500 increase done by Akshay includes his profit margin and the value addition done by him on the finished goods. Now again, this being sale transaction, GST is applicable at 18%. So the sale price would be 19,500 plus 18% GST, which is 3510. That is 23,010 rupees. Again, Akshay, after receiving his payment, he will pay the GST portion to the government. So now the government has 3,510 as GST from transaction number 4. Let us go to transaction number 4. Ramesh, who is a retailer, sells this goods further to Sujay, who is a consumer. Ramesh charges 25,000 plus 18% GST to Sujay. So Sujay pays the amount to Ramesh, and again, like earlier transactions, the sellers who collects the GST pays it to the government. In this case, Ramesh pays 4,500 collected to the government. Now the government has received 4,500 from the fourth transaction. Here, one important point is to be noted that Sujay is a consumer, so he has purchased the goods for his own use and not for resale purpose. Hence, he is the final consumer of the goods. Therefore, the goods has received its final consumer. Let us now see how much GST the government has received in total from all these transactions. Take a look at this table. Transaction 1, sale price was 10,000 and GST at 18% on that was 1,800. Likewise, in second transaction, 2,700, in third, 3,510, in fourth, 4,500, and the total GST that the government has received comes to 12,510 rupees. Correct? Okay.
Let us see some more details. We have seen that GST is calculated as a certain percent on the sale price of the goods. Correct? Okay. So let us compare. In our example, the final sale price of the goods was rupees 25,000. And the total GST received by the government was rupees 12,510. Now, because the GST on this goods is at 18%, the total GST received by the government should also be 18% of the price of goods. Correct? Okay. But here is a problem. This total GST as compared to the final sale price of the goods is not 18%. But it comes to 50.04%. That means the government in the end has received a total of 50.04% of GST on this particular goods. But we calculated everything on the basis of 18% only. We also cross-checked it at the end of every transaction. Yet, there has been some mistake. But we don't need to worry. Because this is nothing but the effect of double taxation, and it is called the cascading effect. Now, we will do one thing. We will see the same transactions again, but with a small change, and see whether with this small change, are we able to eliminate the cascading effect.
Let us begin. A small change that we are going to make is, see, all the calculation that we did above was correct. We charged GST on sale price, which is no doubt correct. Buyer at each stage paid GST at the prescribed rate on the sale price. That is also correct. No doubt in that. But still, the amount that the government received in total at the end was way too much more than that it should have received. Right? That means this is the area where there should be some mistake. So, The change that we are going to make this time in the above example is that we are going to apply value addition method in our calculation for calculating the amount of GST that the assessor should pay to the government. Okay. So transaction number 1, see, Gopal is a raw material supplier. That means Gopal is a first stage supplier. Meaning, whatever raw materials he has, they are not purchased from anyone. And because he has not purchased it from anyone, he also has not paid any purchase price and so not paid any GST on purchase on them as well. Correct? Okay. Also, because of this we can say that whatever raw materials Gopal has, the entire value of those raw materials is generated by Gopal only. Okay. So Gopal sells this goods to Raj and the sale price and GST are as given. The GST will be charged at 18% on sale price, which comes to 1,800. That is 18% on 10,000. Now Gopal sold the goods and received the sale price along with GST amount.
Now Gopal will transfer this GST amount received by him to the government. Correct. Okay. The small change that we are going to make is that, in this method, we will calculate the amount of GST that is to be paid to the government on the basis of value addition method, that is nothing but the value added to the goods at each stage, and not on the basis of GST collected from the customer. So that way, according to this method, the GST in this transaction will be calculated on the value addition done at this stage. Now the question is how to calculate the value addition done at each stage. Let us see. The formula for calculating value addition is sale price minus cost price. So here, in our first transaction, the sale price is 10,000 and the cost price is 0. Because Gopal is a first stage supplier and the raw materials that he has are not purchased by him, but they are created by him. For example, say a potter. A potter for making pot uses mud from his own land and makes pots from it. He does not need to purchase mud from anywhere. So hence the value of that pot is entirely created by him only. So applying the formula we can say that the value addition done in this case is rupees 10,000. That is sale price 10,000 minus cost price, which is 0. Comes to 10,000. So GST will be 18% on 10,000. That is 1,800. And this amount will be paid to the government by Gopal as GST. So no change here from the first transaction.
Let us go to the second transaction. Here Raj is a manufacturer. He purchased raw materials and added value to them by doing some process on it and created a finished product. Then he sells it at the price of 15,000. The GST on this comes to 2,700. Raj receives this sale price with GST amount. Now Raj has to pay the GST received by him to the government. Because we are using value addition method in this example, we will have to find out GST payable to the government by Raj by using value addition method formula. What is the formula? Value addition is equal to sale price minus cost price. In this case, sale price is 15,000 minus cost price is 10,000. So the value addition done at this stage by Raj comes to 5,000. So the GST payable to the government by Raj will be 18% on 5,000, which is 900. So Raj will pay 900 as GST to the government. So government will have 900 from transaction 2 as GST in this method as compared to 2,700 from last method. Same in transaction 3 sale price is 19,500, cost price is 15,000, Akshay sells goods to Ramesh and receives the sale price and amount of GST from him, which is 19,500 and 3,510 GST. Now Akshay has to pay GST to the government. So let us find out value addition. By applying the formula, value addition comes to 4,500. So GST will be 810. 18% on 4,500. So Akshay will pay only 810 as GST to the government in this method as compared to 3,510 from the last method.
Same in transaction 4. Sale price is 25,000. GST on sale is 4,500. Ramesh receives the sales price and GST amount from Sujay. Now the value addition here is 25,000 minus 19,500, which is 5,500. GST on that will be 990 rupees. So Ramesh will pay only 990 as GST to the government in this method as compared to 4,500 in the previous method. Because Sujay is the end consumer. He has purchased the goods for his own consumption and not for resale. So the chain of transactions ends here. Now let's see how much GST has the government received in total using the value-added method of taxation. Take a look at the table. 1,800 from transaction 1. 900 from transaction 2. 810 from transaction 3. 990 from transaction 4. Total comes to 4,500 total GST received by the government. This 4,500 is 18% of the final sale price of the goods. That means we can say that the government has received the correct amount of GST that it should have received from the value of goods. That is 18% on the final sale price of the goods. This is value-added system of tax. This is how this system avoids double taxation and cascading effect. Take a look at the two tables.
By studying these two examples, we saw how double taxation is avoided by using value addition method. But in these examples we saw one transaction at a time, and so we could easily find out the value addition done at each stage individually by having readily available sale price and cost price of the goods separately. However, in real life a business undergoes many transactions simultaneously. And so to find out the sale price and cost price of so many products separately and individually, it becomes difficult and time-consuming. So it becomes difficult to compute the GST payable on that to the government. So to overcome this, there is a concept called as input tax credit, also called as ITC. Let us see what is this input tax credit.
Let us understand this with the help of a table. Look at the columns. Transaction number. Purchase price. GST paid on purchases. We can also call it input tax, because it is on the input of goods or on purchase. Sales price. GST collected on sale. We can also call it as output tax, because it is on output of goods, or we can say sales. And GST payable to government. Let us fill in the details of our example in this table. Transaction 1. There is no purchase price for Gopal. So nil in the purchase price column. No purchase, so no GST paid on purchase. So nil. Sale price 10,000. GST collected by Gopal on sale is 1.800. GST payable to government was 1,800. Transaction 2. Purchase price 10,000. GST paid on purchase by Raj 1,800. Sale price 15,000. GST collected on sale by Raj from Akshay 2,700. GST payable to government by Raj 900. Transaction 3. Purchase price 15,000. GST paid on purchase by Akshay 2,700. Sale price 19,500. GST collected on sale by Akshay from Ramesh 3,510. GST payable to government by Akshay 810. Transaction 4. Purchase price. 19,500 GST paid on purchase by Ramesh 3,510. Sale price 25,000. GST collected on sale by Ramesh from Sujay 4,500. GST payable to government by Ramesh 990.
We will study the table. See the last column. GST payable to government. Let us apply one formula to this column and check if it fits right. Output tax minus input tax. Let us see if it fits. In first transaction, output tax 1800 minus input tax 0. Does it fit? Yes. Second transaction. Output tax 2700 minus input tax 1800. It comes to 900. Again it matches. Third transaction also it is true. 3510 minus 2700 is equal to 810. Fourth also true. 4500 minus 3510 is equal to 990. So, we can say GST payable to government by an assess is calculated as output tax minus input tax. Okay. Now this input tax is nothing but input tax credit. ITC. Input tax credit is nothing but the GST paid on purchases. It allows businesses to reduce GST liability by claiming credit for taxes paid on purchases, preventing double taxation. So this is how it becomes easy to calculate the GST payable by an assess to the government without requiring to find out the value addition done at each stage. By using this simple concept of input tax credit and the formula for calculating the GST payable to government, that is, output tax minus input tax credit. Hope you have understood the concepts of input tax credit and GST.